G'day everyone and welcome to this residential property webinar. My name is Tim McGowan and I'm the host for today. Now the residential real estate market is estimated to be worth $8.6 trillion, which is about 3 times the value of the ASX. So demand for an interest in the Australian property market has never been more intense. Now every day Australians discuss the property market all the time. They talk about property pricing to their neighbours, at work or at a barbecue. And it's become a key driver of our individual wealth and more often than not, an asset more valuable than our superannuation. And in turn, the next generation wonders how they'll ever get a footprint in the market given the extraordinary growth of house prices over the last couple of years, decades, or even longer. So today you'll hear from the experts, from property analysts to real estate agents from around the country to a real estate company you can invest in directly via the ASX. So let's make a start. First up, we have the management of ASX listed real estate company, the Agency Group, ASX code AU1, if you want to buy their shares. We have with us the Managing Director, Paul Neodoni, and the Group CEO, Jeff Lucas. Over to you, gentlemen.
I'd like to thank everyone for joining us this morning. And thanks to both Tims, Tim McGowan and Tim for CoreLogic, to joining us. This is a unique presentation where we're going to overlay what the property market's done and what it will probably continue to do with what the agency has achieved in the last 12 months and since its inception in 2016. I'll start the presentation here, and it's just a quick one on AU1. And then I'll hand over to Jeff Lucas, who's our newly appointed CEO or Group CEO. Okay, if we can move to the next page, Dave. Obviously the disclaimer, the one after that. Okay, so what's AU1? Okay, so in a nutshell, AU1's a scalable, vertically integrated real estate services company. What does that mean? Well, that means we do property sales, we do property management, we do mortgages, we do financing, and we do conveyancing in WA. Now, when you look at these services all piled together, I can tell you now that the gold standard in the US at the moment for real estate companies is to be able to successfully add mortgage broking to the business. We started with these two hand in hand from day one. Now, we've continued to recruit agents and grown existing and new markets, which has been very pleasing. Okay, so our business model. There's a lot of copycats out there. But we were the first to put the agents at the core of our model. The agents are our clients. And we do two things with the model. We offer higher commissions, but more importantly, we offer support to the agents so they can do their job better and easier. Now, a lot of people are trying to copy this. No one's copied the support. There's a lot of copycats out there that are offering high commissions, but there's no support attached to it. So that's our advantage, and we continue to grow that in our armory. At the moment, what have we achieved? So last year we achieved a $700,000 EBITDA, and this year we're looking at achieving a $4 million EBITDA, which is a very good increase. In the last 12 months, due to COVID, we were able to stabilize our balance sheet. We've got our financing down to $8 million. This is against assets worth $25 million, which was also pleasing. We've also got external validation. In doing that, as you can appreciate, a lot of the banks were nervous with COVID. Our interest rate started at over 8%, and now it's dropped down to 3.75%. We've had a WA entrepreneur in Bob Peters join our share registry. He supported the company by immediately converting $3 million of his convertible note to become one of our major shareholders. And also, as I mentioned, we added Jeff Lucas, who joined us from a successful real estate company, McGrath, to come on board and become our CEO, Group CEO, to help our growth nationally and on the East Coast. I won't talk about the macroeconomic tailwinds. I'll leave that to Tim to talk about further. But what about our scalable footprint? So the important point is now that we have got a scalable footprint, and that's being demonstrated by the EBITDA we're achieving. So that means now we can expand and grow and add agents to our platform. without it costing us a great deal of money. We have got many markets still available to us. As you know, we've just opened up in Queensland, which has been great and is already showing some success. We still have markets in South Australia, Northern Territory and Hobart to add. We've got great potential still to grow in New South Wales, Victoria and WA. But our key, and I think our secret weapon at the moment, is our second brand, which is SLP. We're going through a rebranding of that at the moment, and it's one of our priorities to launch this brand nationally as our second brand. And this will attract agents as well. Can we move to the next slide, please, Dave? Okay, so this is just a quick history of where we've come from. So we listed at the end of 2016, and that was December 2016. In 2017, we had the good fortune of being introduced to Matt LaHood, who led a crew from the McGraths who came across to the agency, and they effectively set up our East Coast presence. In 2018, we purchased SLP. And in 2019, we actually brought in-house the East Coast presence into the company. So 2020, as I said, we made our maiden EBITDA. With 2021, we're hopefully stretching it out to $4 million. So when you look at that, if you look at in reality, the 4 years from 17 to 21, we went from 0 to 300 agents, from 0 to 80 million in GCI. So that is significant growth, and Jeff will show you and demonstrate the growth later on in the presentation. But it comes down to this. So transactions is what drives this business. And getting transactions, you need good agents and you need a lot of agents. So we've got to 0 to 300. So the opportunities in the markets that we've got, as I mentioned, in Queensland, in all the states, in effect, to grow the team, to double the size of the team is achievable, and it's out there. And if we do that, we will have over 2% of the Australian market, which will be an incredible achievement. So just to sum up, there's a lot of opportunity. It's about transactions. Transactions is about the number of agents, and good agents, not just any agents. And we pride ourselves on attracting good agents and growing this business. Okay, Jeff, that's probably a good segue for you.
Thanks very much, Paul. Thanks, David. Yeah, good morning, everybody. Thanks for joining us for this very short overview on the agency before we get into the really interesting material that Tim Lawless is going to present. Paul mentioned the national footprint, and that's important because we are a truly national business. And in these times when we're getting some challenging circumstances re-COVID in different states, you can actually see the benefit of being a truly national business. You know, we've got WA over there, currently pristine and operating in full steam. And that's a really important business for us as well. So the way that we've structured our business is so that if one state or part of the country is having difficult economic times, invariably other parts are actually being successful. And we're seeing that right now. So you can see by that national footprint there, the distribution of our agents. Now, we're different to a lot of other traditional real estate businesses that have a lot of offices dotted around the countryside. We have 19 offices only currently in our footprint, but only 6 of those are actually our company offices. The others are populated and funded by the agents themselves. You can see on the left-hand side there, agent growth has been important to us, the number of agents. We had modest growth in the last financial year, and we expect that to start to grow significantly. And we've made a good start to that in the current year. So you'll see us reporting on that as we go forward. I'll just move to the next slide, please, David. And Tim, in his opening statement, talked about the importance of the Australian residential real estate market. You can see there on this slide that this was as at July 2021 at $8.6 trillion. That is the asset value of the Australian residential sector. Now, Tim, without stealing your thunder shortly, he'll talk about that having grown to already 8.8 trillion in the short period between July and today. And that has been the trajectory that we've seen in unprecedented growth in prices over the last 6, 9, 12 months Interestingly, the growth in the last 12 months, this is an interesting statistic, has actually been about 50% of the entire Australian GDP is represented by 1 year's growth in residential real estate. So it's an important sector. You'll see on the right-hand side the relative size of this sector that we work in and operate in compared to other sectors. For example, if you compare that to the entirety of the ASX, the value of residential real estate is more than 3 times the size of the entire ASX. Moving to the addressable market, and that's what's really important to our investors and stakeholders. There were 583,000 sales in the last 12 months, and that represented a gross value of $376 billion. If you break that down to what's really important to the operating business, and if you take that $376 billion at an average commission of 1.6%, the available commission pie for the Australian residential agency sector is approximately $6 billion. Now, to put that into perspective, we did 80 million of that 6 billion. So although we've got a national footprint and we've grown very strongly, we're a very small part of the market, coming in at just 1.3% of the commission pie in the last 12 months. In terms of number of transactions, we did 4,964 as a percentage of 583,000, about 0.85% of the market. And we also transacted 4.84 billion in residential real estate. Moving to the next slide, please. This just attempts to show the extent of the growth that the company in its very short history of 4 years has achieved. And I guess the most salient graph there is on the bottom left-hand side, where we show 4,964 sales compared to 3,147 in the prior year. Now, that's an increase of 57.7%. Granted, and you'll hear it from Tim, the market has been very, very strong. In fact, the number of transactions that have occurred in recent months have outstripped significantly the average over the last 5 years. Notwithstanding that listings are actually down, the volume of transactions has been up strongly, and that's important. So the number of transactions the increase in the number of transactions in the Australian real estate industry for the last 12 months was 40.7 for the industry. So a number of agencies and businesses are talking about their success and their growth. What we think is important is to benchmark ourselves against the market. And pleasingly, we had growth of 57.7 versus the industry of 40.7. And we'll continue to benchmark ourselves against that, because what's important to us is to grow that market share from our current 1.25% to what we believe can be very much more than that. Next slide, please, David. Just turning briefly to the financials, and this slide just gives you a few key takeaways on those. Paul mentioned it. We expect to exceed 4 million in EBITDA this year. Yes, it's a strong increase on the prior year. And we recognise it's a relatively small number. The important thing here is that we're a relatively new business and we needed scale to achieve covering our costs. We've done that. We did that in the prior financial year. Now what you're seeing is as we continue to grow, we continue to leverage that margin, and we expect that EBITDA to grow into the future. The result has been struck on 4,964 sales. That is a 65% uplift on the prior year. Pleasingly also, our gross commission income of 80.7 million is a 68% uplift on the prior year of 47.9. So that gross commission income is really the aggregation of all of the commission income that's earned by each one of our circa 310 real estate agents across the group. Importantly, just at the bottom of that slide, we refer to a $25 million asset. Now, that's the independent valuation on our rent roll. That's approximately 3,900 properties in strength, one of the larger rent rolls in the country. And it also reflects the independent value of our mortgage broking book that Paul referred to before. Moving to the last slide. Here we set out, I guess, the corporate structure of the business. And you can see on the left-hand side, the current structure of our shareholding register. Importantly, you'll see at 8% are directors and management. More importantly, of course, is that 16% of the stock is held by our key agents. And we think that's something that differentiates ourselves to many of the other competitors in the marketplace. Daring Investments at 6% was a founding corporate. And Paul mentioned before that Peters Investments at 30%, that's by virtue of them converting 50% of the convertible note that they invested in some 12 months ago. The rest of the register, 40%, is held by other people, other parties. Very quickly across to the corporate snapshot on the right-hand side, we currently have 428 million shares on issue. We have a market capitalisation of just $23 million, and that's struck at the current share price of 5.4 cents. We have cash that you'll see reflected in the balance sheet in our financial accounts, about $5.7 million. And we have financing facilities of 8.35. That's comprised of a very much reduced Macquarie Bank facility, now down to $5 million and negotiated at an interest rate of 3.75%. And in addition to that is 3.3 million remaining of the convertible note from Peters Investments. Also, just at the end there is the reference to that hard asset that's been independently valued, and that's our rent roll and our mortgage book. So that, in a nutshell, is the entity that is producing these rapidly growing results. And I'll now hand over to Tim for the next part of the presentation.
Great, thanks, gentlemen. Now, before we move ahead, we've got some questions. So if you type your questions in the Q&A box provided, we'll get to them at the end of the next presentation when we bring together a panel of Australia's best real estate agents and today's experts to answer your questions and to talk property in general. Okay, next up we have Tim Lawless. He's the head of research at CoreLogic Asia Pacific. Now he'll provide an exclusive update on the latest national real estate data and the trends for the coming 12 months. Tim, thanks for your time. Over to you.
Hi, Tim. Thank you very much. And thanks to Paul and Jeff. It's fantastic to hear about your success over such a short period of time as well. My session today, guys, I'll try to fit everything into about 20 minutes. But in that time, I'd like to cover off on what we're seeing in housing trends, of course, both from a values perspective, but also transactionally. You know, what's really behind such a strong market we're seeing at the moment is really a disconnect between supply and demand. So the demand side, we can see in very high transaction numbers, as Jeff covered off on, but listing numbers or advertised supply remain extremely low. And that's really at the crux of this upwards pressure on prices. I'll touch a little bit about rental markets, and I'll finish up with some of the headwinds and tailwinds that might be ahead of us. And what are some of the forecasts looking like as well. So if we can flick to the first slide, just to recap on some of those figures that Jeff was covering off on. He mentioned that the overall value of real estate had risen to 8.8 trillion by the end of July. Amazingly, we only saw the housing market click over the $8 trillion mark from memories about March or April this year. So this is the result of both an addition of new dwellings coming into the market. We are moving through a bit of a building boom at the moment, but also, of course, just the rapid rate of appreciation in housing values. With such a large overall asset value, it makes it a lot easier to understand why there is so much focus on housing. Remember, about a little bit more than half of household wealth is held in this housing asset class, and about 60% of bank balance sheet debt's also in residential mortgages. So what happens in housing really is quite meaningful, both from a consumption perspective. Remember, about 60% of Australia's economy is consumers out there spending consumption, and they generally spend more when they feel wealthier. So the wealth effect has certainly kicked in as we've seen housing prices rise, but also there are financial stability risks associated with housing and home lending, which is why we see so much focus from the regulators and the policymakers on housing markets and the lending that surrounds housing markets as well. So let's flick to the next slide, David, and we'll look at some of the trends that we're seeing in housing values. So unless you've been living under a rock, you'll be knowing that housing markets have been rising quite quickly. So let's look at the first set of graphs on the next page, and we can see what those trends look like. Let's jump to the next page, and we can see that the trend in housing values has been extremely strong. You can see this is a rolling 3-month change in housing values across each of the capital cities. Quite substantial growth over the past 12 months. In fact, nationally, we've seen housing values rise by a little bit more than 16%, a bit more in the regions, a little bit less in the capital cities. But more recently, that rate of growth has just started to taper off. So we've probably already moved through the peak of the growth cycle. That, of course, doesn't mean that housing values are falling. It just simply means that housing values aren't rising quite as quickly as what they were back in March of this year. That's when we saw the peak rate of growth. So in markets like Sydney, for example, we're seeing housing values rising at nearly 4% month on month. That's now reduced down to a monthly growth rate of about 2.8%. And we've seen the quarterly growth rate reduced down to just below 8%. So we can definitely see a little bit of momentum coming out of the market. I think in anybody's books, these are still very strong growth numbers, well above average. Typically on a year-on-year basis, you'd expect housing values to rise at around about 3%. That's the average over the past 10 years. So to see housing values up more than 16% over the past 12 months, and rising nationally at 1.6% month to month, clearly that's still well above average. And my expectation is we'll probably see a further tapering in the rate of growth through the second half of this year and into 2022, mostly due to the fact that housing is becoming more unaffordable. As we see household incomes rising at around about 1.5% year on year, of course, we're seeing housing values rising at more than that in the space of 1 month. So it means that it's going to take longer for households to save for a deposit and actually get into the market. Another trend on the next page, this is another one of the headline trends, I suppose, is that we're seeing house values rising substantially more than unit values. This is something we see through most growth cycles, by the way, so it's nothing new, but the performance gap is much larger than what we've seen over previous cycles. And I think this really reflects the fact that we're seeing a change in buyer preferences away from density. I mentioned affordability before, so probably we will start to see more demand being deflected back into some level of density going forward where price points are generally cheaper. But it's pretty clear, almost every capital city, Hobart's the exception, is seeing house values rising more than unit values, and quite a substantial outperformance in markets like Sydney, Melbourne, Brisbane as well. Part of this, I think, comes back to the fact that we're moving through a global pandemic. So I suppose, understandably, people don't want to live in a high density situation where there's a lot of shared amenity and in close quarters with other people. But I think there's more to it than just that. I think, we're seeing a lot more first home buyers in the market, though they're just easing off a little bit now. There seems to be a demand for detached housing from that market. And we're also seeing a lot more people being able to work more flexibly or remotely, which has really opened up a lot of the outer fringe markets and the regional markets, particularly the regional coastal markets, where previously commuting times or just that distance was a larger barrier to entry into those markets. Whereas now, if you can work, say, from home 3 days a week and only have to commute 2 days a week, it makes that commuting time, or that barrier of commuting time, much less substantial. On the next page, you can see there's another trend where, I talked a bit about affordability, where we have seen housing values in terms of a dollar sense absolutely reaching new record highs almost everywhere. So the typical value of a Sydney house now is getting up close to $1.26 million. Melbourne is now above, or nearly at $950,000. You can see Canberra coming at number 3 there. Every capital city is at a new record high, apart from Darwin and apart from Perth. Both those cities, of course, went through quite a sustained downturn between the middle of 2014 and the middle of 2019. So buying into a market like Perth, for example, you're still buying in around about 14% below where values were back in 2014. So you're paying sort of around $2,009 in that marketplace. So very good value for money, but you can see values are rising pretty much everywhere. And you can also see on a graph like this, how big a difference there is between house values and unit values as well. To my point that we're probably going to see more demand being deflected back towards, say, townhomes, apartments and so forth as well, simply due to the fact that that's where more people can afford to buy. On the next page, we're just going to cover off on some of the trends we're seeing between regional areas and the capital cities. So let's look at the first graph. On the next page, you can see that the trend between regional markets and capital cities has been quite substantial. There's been quite a substantial performance gap that's opened up mostly through the second half of last year. But coming into 2021, that performance gap has really narrowed. There's not a great deal of difference between how the broad regional area of Australia is performing compared to the broad capital city markets. Okay, so part of the attraction of regional markets has been their sheer affordability, but of course, with housing values rising substantially more over the past year and over the past 5 years in regional Australia than capital cities, that affordability gap has narrowed to some extent. Probably also this trend, this narrowing of the trend could be driven by the fact that some cities have moved back to more workers returning to the city. The inner city market's becoming a little bit more vibrant. Can't really say that about Sydney at the moment, unfortunately, moving through such an extended lockdown. I hope anybody dialing in from Sydney is going okay down there. But chances are we'll probably see this performance gap between the regions and the capital cities continue to narrow, and maybe even see the capital cities outperforming the regions going forward. But if you look at the next page, we can start to see some of the trends that are becoming more and more evident. Look at Melbourne, for example. Melbourne versus regional Victoria, there is still a pretty substantial gap. This is just looking at the first 7 months of 2021 and how much housing values have changed over that first 7 months of the year. You can see in Sydney, compared to regional New South Wales, not a great deal of difference. Brisbane compared to regional Queensland, not a huge difference. Melbourne really stands out, and it's also the city or the state in Victoria where we are seeing a much more substantial internal migration flow away from the capital cities into the regions, and a lot fewer people moving from the regions back into the capital city. So a much more clearer demographic shift in Melbourne. Maybe that goes back to the extended lockdown that they saw through late last year. That probably did inspire a lot more people to move out of Melbourne. But it will be interesting to see how that pans out. It's probably the one market where we're still seeing quite a significant performance gap. If we look at this in a bit more detail, on the next page, we can see the top performing markets around the country. So regardless of whether they're regional or capital city, I've ordered this list based on the 12-month change in housing values. So you can see there are some really obvious trends in a leagues table like this. The first one is that most of the top performing markets you could probably describe as having some sort of lifestyle element to them. You've got the Northern Beaches in Sydney, the best performing sub-region around the country. These areas, by the way, are based on statistical area 4s, right? So a step down from the capital city area. So it gives you a pretty good idea of sub-regional performance. So you've got the Northern Beaches where housing values have risen by nearly 30% in the space of 12 months. Then you've got the Richmond Tweed region. That includes markets like Byron Bay down to Ballina, okay, or Tweed down to Ballina, including Byron Bay. You've got the Central Coast, another coastal market, which is actually inside the Sydney metro area. With the Southern Highlands and Shoalhaven. Well, Southern Highlands is not really coastal, but definitely has some lifestyle element to it. Shoalhaven's coastal. Coffs. Then you get out into Sydney's west, the Mornington Peninsula, the best performing region in Victoria, also coastal and quite out of fringe, the Sunshine Coast. So you can really see this trend. A lot more people are trying to position themselves into a lifestyle-driven market, and most of these areas also have commutability back into a major capital city or a pretty decent airport within close proximity as well. There's a few examples where that aren't meeting that lifestyle trend. Of course, you can see a few markets like Latrobe and Gippsland. You can see Wagga on this list. Some markets where, agricultural markets are starting to bounce back as well because the drought's broken a lot of areas. But broadly, this is very much a lifestyle driven trend we're seeing around the top performing areas. And you can see exactly the same trend in rental markets, by the way, as well. So let's skip over to the next part of the presentation and we'll look at some of the underlying supply and demand dynamics. So what's really driving this upwards trend is absolutely a disconnect between the number of homes that are available to purchase at the moment, so listing numbers, and how much demand is in the market. So let's look at demand first. On the first set of slides in this section, you can see the demand trend. So this is the number of home sales. Okay, this blue trend line here represents the rolling annual number of sales across Australia. Okay, the red dotted line is the current level. So you can see that we haven't seen sales activity this strong since 2004, at least on an annual basis. And the monthly numbers were at record highs for the number of sales we're seeing across the market. And look at the 10-year average. We're currently seeing sales activity about 31% above the 10-year average and around about 42% above the 5-year average. So absolutely a very strong demonstration of how many buyers are active in the market. Flick the next page and we can see that that trend is evident pretty much everywhere, right? You can see, well, houses are seeing a stronger trend in demand than units. I mentioned that a little bit earlier on. You can see that in the main graph. But the graph off to the right, which looks at the annual change in settled sales across each of the major regions around the country, you can see that there are some markets like regional WA has seen an 80% increase in the number of home sales year on year. Perth is up 62%. You can see Sydney is up about 37% year on year. Fair enough, last year there was that downwards trend that we saw at the beginning of COVID. It's fair enough to say when you compare back to the 5 or 10-year average as well, we're still seeing a substantial uplift in overall sales activity. Then on the next slide, just give a mental snapshot there of demand. This is what supply looks like. Okay, I think the best way to look at a proxy for supply is how many homes are actually available for sale. You can also look at how many new homes are being built. That's another measure of supply. It's newly constructed properties. But in terms of actual advertised or available supply, this is probably the best measure. And we're looking at new listings on the left and total listings on the right. These graphs are really useful for measuring listing numbers or anything that's really seasonal. So we're looking at a point in time and comparing back to the same time over previous years. So on new listing numbers, you can see there's been this downwards trend in new listings. New listings are tracking nearly 2% below the 5-year average at the moment. And this is a relatively new phenomenon. Before this second round of sort of major COVID outbreaks, we were seeing new listing numbers tracking around bang on average. And they're starting to trend low. They've been trending lower for some time now, mostly due to the drag in, say, Sydney and Melbourne as they went through their lockdowns. And now Brisbane, which has just come out of a lockdown, has also been showing fewer new listings coming on the market. But probably more important to that is the total listing trend here on the right. The total number of listings available for sale is down about 28% on the 5-year average. Mostly due to the fact that, well, we've got new listings that were about average, but sales activity is around 40% above average. So that really rapid rate of absorption, where we're seeing homes selling really quickly, average time on market's about 28 days across the capital cities. Clearance rates are still up around the 75% mark, very little in the way of discounting rates as well. All those metrics highlight just how fast the rate of absorption is in the marketplace. So if you look at the next page, you can see these listing trends from city to city, and you can see some of the disruption that I've been talking about. Again, this is new listings across each of the capitals, and you can see how severely the number of new listings has fallen across Sydney since early June as we started to move through these lockdowns. You can see how volatile it's been through Melbourne. Melbourne moved through an earlier lockdown and then it came out and then went back into lockdown, and you can really see how much that's disrupted the new listings trend. Brisbane only went through a 7-day lockdown. If I was to update this number for this week, so you'd start to see a little bit of downwards activity across Brisbane, which will be short-lived as well. So absolutely, I think the main story here is generally through these COVID spot lockdowns, we are seeing some disruption to activity, particularly listings activity, to a lesser extent sales activity, but we're not seeing that being impact on housing values. Housing values have been very, very resilient, if not, continuing to rise quite strongly. On the next page, you can see the trend in total listing numbers is generally been trending lower, particularly if you look at markets like, say, Brisbane, Adelaide, Perth, Hobart. Listing numbers are substantially below where you'd normally expect them to be. Melbourne is the only market where total advertised listing numbers are roughly around average levels. In fact, 1% above the 5-year average. And probably not too surprisingly, Melbourne's also shown the lowest annual growth figure, up about 10%. Still a very strong market, don't get me wrong, but certainly seeing supply and demand a little bit more evenly matched in the Melbourne area. Okay, let's move on and we'll look at who's buying in this marketplace. So this is definitely a market that's been characterized by strength from owner-occupiers. You can see that in the graph on the left. The best way to get a proxy for who's buying in the market is looking at mortgage data. Okay, so I'm using Australian Bureau of Statistics housing finance commitments data here. You can see that non-first home buyer owner-occupiers are well and truly the largest component of demand of the market. But more recently, we've seen investors overtake first home buyers. And if you look at the quarterly growth rates, the graph on the left, sorry, on the right, you can see that investors are now rising the fastest as a component of mortgage demand. So over the June quarter, we saw the value of investor loans rose by about 24%, whereas first home buyer loans were down by about 4% over the quarter. And we saw non-first home buyer owner-occupiers lending rise by about 10% over the quarter. So definitely seeing a bit of a changing of the guard here in terms of the level of demand in the market. So first home buyers drifting a bit lower, investors starting to step up. You can start to see that on the next couple of graphs. I won't dwell on these graphs too long just for time purposes, but you can see investment is ticking up pretty much everywhere across the market, but remains well below average. Across Australia, you typically expect investors to be around about 35 to 36% of mortgage demand. Nationally, they're about 28% of mortgage demand at the moment, but starting to lift, partly due to first home buyers coming down, but also due to the fact that investors are growing as a segment faster than others. And on the next page, you can see exactly the opposite, where first home buyers are now winding down out of the market. Okay, partly due to affordability constraints, partly due to less incentives as well. Incentives like, say, the home builder grant was very popular amongst first home buyers. Stamp duty concessions, for example, have expired in Victoria as well. Some of the other fiscal support, of course, generally expired in March of this year as well. So probably this is more about affordability becoming more impactful, but also about less stimulus in the marketplace for investors. So let's skip to the next, for first home buyers. Yeah, the next page, we're just going to look at rental markets, and we can see that rental markets have become extremely diverse. This is the annual change in weekly rents across each of the capital cities. You can see that markets like Darwin and Perth, extremely strong. Rents are rising more than 20% in Darwin per year, more than 15% for Perth houses, nearly 15% for Perth units. Then you go down to the other end of the spectrum, and you can see the unit markets, particularly in Melbourne and to a lesser extent in Sydney, have been much weaker. This is really reflective of the high-rise inner-city apartment precincts where vacancies have been very high. In fact, in Melbourne's inner-city precincts, we've seen rents come down by nearly 30% since March last year. Sydney, not quite as bad. We've definitely seen demand coming back into the inner-city precincts of Sydney's apartment marketplace much more quickly. Remember, Melbourne is more exposed to overseas student numbers as a prime tenancy component of those inner city high-rise precincts as well. Whereas in Sydney, the apartment market is much more mature, and we're probably seeing a lot of demand being sucked in from the middle ring areas as well, due to the fact that rents have come down more substantially. On the next page, you can see yields, of course, have compressed. Not that big a deal when you consider mortgage rates have also come down substantially. But in markets like Sydney and Melbourne, your gross yield profile is now well below 3%. Every other capital city is at 4% or higher. So it's becoming pretty straightforward to find cash flow positive investment opportunities outside of Sydney and Melbourne. But in Sydney and Melbourne, you'll find finding a cash flow positive opportunity in those markets is a bit more like a bit of a needle in the haystack, that's for sure. So just to sum it up on the next page, there are a lot of tailwinds in this marketplace, but there's also a few headwinds as well. In terms of the tailwinds, low interest rates is the primary one. We're not expecting interest rates to start rising anytime soon. We've already started to see longer term fixed mortgage rates lifting a little bit higher, but variable rates and short-term fixed rates, 3 years or less, generally still at record lows, even trending a little bit lower over recent months as well. Interest rates could rise a little bit earlier than what the RBA has suggested. They're still saying 2024 at the earliest. Could see rates rise a little bit earlier than that if we do see the economy continuing to bounce back so strongly, labor markets tightening, pushing up wages growth, which would get the inflation target met a little bit earlier than 2024. Okay, the economic recovery very strong, but do expect there is going to be a downwards blip in that through September. We are expecting there will be a negative GDP result through September, and that probably will be short-lived as long as we see New South Wales coming out of their extended lockdown through the December quarter. Let's hope that actually happens. And we're also seeing a rollout to the vaccine starting to ramp up more substantially as well. The headwinds are more around things like the potential for credit tightening. The timing of that, if it does happen, is still highly uncertain. At the moment, lending standards have been held up pretty well, but it's something the RBA and APRA are talking about repeatedly. And then later down the track, the potential for higher interest rates or new supply, a lot of new supply coming into the marketplace as well, could soften things out a little bit. And just to wrap things up on the final page, this is where the economic commentariat is forecasting housing prices to go over the coming couple of years. I've taken 3 of the big 4 banking forecasts. ANZ was quite similar. I just couldn't find a graphic suitable for this page. But each of these forecasters are suggesting that growth through 2021 will probably be up around 18 to 20%, but of course, slowing down through 2022 due to affordability constraints and the high potential for a tightening of credit conditions as well. And coming into 2023, probably the first signs of some negative pressures as we move through the downside of this very strong growth phase. So Tim, I'll wrap it there. I might hand it back to you and we can jump into the panel. Thanks very much.
Great, Tim. Thanks for your time. Yeah, we will open it up to the panel now, and I'll just introduce who we will have on the panel. We're welcoming back Jeff Lucas from the agency. We've got Matt LaHood, who's the CEO of Real Estate, the agency in Sydney. We're then going to Victoria. We've got Peter Kakos, who's the General Manager and Head Auctioneer in Victoria. We also have David Price, who's representing Queensland as the General Manager of the agency up there, and Stuart Cox, who is the General Manager of WA, the agency, of course. Now, Tim, before you go, and we have lots of questions, we're in a unique environment for real estate. We've got COVID, of course, which is meaning lower supply of homes. We've got some forgiveness of debt by banks at the moment with people out of work. Can you talk to debt levels? Are people increasing their debt levels as they chase home values?
Yeah, great question, Tim. Household debt levels are on the radar, that's for sure. So through COVID, or through the worst of COVID last year, we did see household debt levels come down a little bit, mostly due to the fact that households started saving a lot more and borrowing a little bit less, but quite quickly that turned around. So when we saw the March household debt numbers come out from Reserve Bank, they'd pretty much retraced back to where they were pre-COVID. So we see most of household debt is actually housing debt. So that's about 70% of household debt. And it's definitely something that the Reserve Bank is well and truly watchful for. Household debt is very serviceable at a time when interest rates are as low as what they are. That's not an issue at all. The key concern from regulators like the RBA is what happens when interest rates have to eventually rise. If we have a really heavily indebted household sector, it means they need to dedicate more of their incomes towards servicing their debt and less towards spending. Remember, I mentioned that the economy in Australia, about 60% of economic growth is consumption. So the RBA would see household debt as a key financial stability risk if it did rise higher, and potentially could be a trigger for one of the macroprudential responses where APRA would probably look to minimize say high debt to income ratio lending or high LVR lending where borrowers have a small deposit.
Okay, now let's go around the country, actually. We'll start in Sydney, which is my hometown. I'm sitting in downtown Sydney here. Matt, you've heard you've seen the data from CoreLogic. How do you see things in New South Wales?
Yeah, Tim Lawless said, Tim, good afternoon. And Tim Lawless, that was outstanding. Always very thorough when you present. Thank you. Look, yeah, it's pretty much a snapshot of what Tim said, Tim. The reality of what I've noticed this lockdown, though, for the listeners is, it's obviously we went through the first one and it was literally tools down. Everybody was, what do we do next? How do we do it? Sort of thing. This lockdown, I've noticed the buyer demand hasn't evaporated and the seller demand hasn't actually evaporated. We're just not seeing it on the market right now. But what I can assure everybody who's listening, there's going to be a very strong bounce back. I'm in touch with my agents every single day, and I'm feeling that the spring is going to be a huge spring this year in terms of volumes of people. I think second lockdown, they've realised, okay, we can still get around, we can still do by appointments. And you're probably noticing in Sydney, the clearance rate has been above 70% every single weekend, which was something I wasn't sure of personally. In terms of where that would be in this lockdown, but it has not come under 70% one Saturday all the way through. Yes, the volume's dropped, but the clearance rate has been and up to sometimes 80+% in this last lockdown. Obviously completely separate in the first lockdown. So I can definitely see a willingness and people sort of revving their engines, waiting for the garage door to open. And that's the feeling I've got from my agents and actual vendors I'm speaking to myself, past clients of mine as well.
Let's go to Queensland with David Price. And David, you've had a harder lockdown on the rest of the states than in terms of letting New South Wales and letting investors into the Queensland market. Can you talk to us about how COVID has affected the property market up there and what you're seeing in terms of pricing?
Yeah, thanks, Tim. It's certainly been very positive, COVID, which is surprising to all of us. We've seen an unprecedented growth and change in our market in the 25 years I've been in real estate. And we've never been traditionally an auction state. We've always been a private treaty state. And our auction clearance rate over the last 18 months has been over 80%. We've found people willing to bid at auctions during the last 18 months. And before that, they were very hesitant. And also people to auction their houses being the vendors. In most cases, we've got anywhere between 10 and 30 bidders at our auctions, which has really increased the level of demand and also increased our prices. And that's really in the core markets we've got all the way along the coastal regions. Another big changing factor has been our unit market. And I know the prices don't reflect that at the moment, but I expect a really significant price jump in our unit market, and that's in the owner-occupier market, because traditionally we've had investors buy into the units, but now with these 3-bedroom units, we're seeing people move from houses or not being able to afford a house to be able to purchase a unit, which has really changed our market significantly. We're seeing off the plan sales at an exponential rate with developers selling their projects out in less than a week or two, which before the things have changed would have taken up to 2 years. Only restraints we've got in our market is the banks, and they're being tough on both investment and owner-occupiers with their restrictions. And that's up to the experts, I suppose, to decide what will happen moving forward. We've also had a very strong growth in our first home buyer market. And although that has seemed to have waned off a little bit, we're finding mums and dads are helping out the younger kids to get into the market. So as before was said by Tim, that they might be priced out. We don't see that happening because the mums and dads are chipping in and saying, we'll help you to get into the market. So very, very strong, and I can't see it changing. I honestly see the growth going for at least till Christmas 2022. And then, who knows from there, but at this stage, we're very, very strong.
And just quickly, have you have a lot of interstate investors who chase the sun to come up to Queensland to invest and retire. Because you've had such a hard close on the border, has that been impacted at all?
No, not at all. We're getting people buying sight unseen off the internet. Today, with all the videos and all the photos, they just don't want to miss out on the opportunity to buy into Queensland, especially near the coast, and they're just buying sight unseen. And we're seeing that a lot. Also, the expats coming back as well. They're buying sight unseen or getting a friend to go and look at it for them, which the friend gives it the tick or the thumbs up, or a mum and dad, then they'll buy it without seeing. So it's been a significant change, the biggest one I've seen in 25 years in real estate.
Thanks, David. And down to Melbourne, where it's been a tough lockdown, and Sydney might be playing catch up at the moment. Peter, can you talk to what's happening down the market down there?
Yeah, thanks, Tim. I think we've been feeding David and his market up there. Just seems to be certainly a little bit of a mass exodus from here right from the very start. But look, the Melbourne market's been just so resilient. We've been able to weather the constraints and the uncertainties. And given it's our sixth lockdown, we're certainly in a good position to talk about what it's like post-lockdown. And I've got to say, each and every time the lockdown has ended, there's been a very big slingshot out, and the sense of urgency is right there. And look, which has been tremendous. And we've certainly have seen that clear demographic shift to regional. So the data points that Tim spoke of earlier do paint a very clear picture, particularly of Melbourne. It was interesting to look at 2020 and the initial lockdowns, and the first home buyers came out in force. They were prolific last year, given the fact of the uncertainty of rentals, and they wanted their own space, and people that was typically the push there for the first home buyers in that apartment market. Investors were pretty much, you just didn't see them because properties and large amounts of properties were remaining vacant. So vacancy rates were quite high. In 2021, we've seen that really shift. So investors have come back into the market in a big way, and first home buyers have dropped off, as we've seen with the data. So that's been really clear. There is tight supply here, well and truly, which is that domino effect of the upgrades in the marketplaces. So there's definitely a move towards off-market listings and sales. They've become more prolific because people are not willing to let go of their own home until they find something. And so a lot of people, so it's a bit of a halt in the marketplace. So I think we'll see a lot more of that now with the spring market, and certainly the conversations we're having. We're expecting quite a lot more properties that'll hit the market. People are looking for different sort of opportunities at the moment. Whether they can't find a home that they want to move into, they'll buy a cheaper home, look for the land component of it, knock it over, and look to develop their own and build their own. So there's certainly a fair bit of that, particularly in these inner Melbourne areas as well. So development opportunities, we're dealing with a lot of investors and developers from all across the country who are starved of opportunities, particularly in Sydney, that are coming to Melbourne. So those opportunities are well and truly growing as well. So I just feel that the water's finding its new level. Whilst it was interesting to have a look at the data and see the big spike, and now it's sort of dropping back a little bit. And as Tim said, not falling, just not raising at a rate of knots. And you can really see that, and we can absolutely sense that the water is finding a new level, and things are leveling out a little bit. But, the rate of, last thing I'll say is that the rapid rate of absorption, days on market are lessening. Auction clearance rates, well, they're still, 70, tracking between 70 and 80%. It's a really resilient market considering what's going on. And, we just hope that continues.
And before I head to WA, Peter, can you talk about supply? I mean, we're coming up to spring. It's naturally a time it's a selling season, effectively. Do you think COVID will exaggerate that in terms of bringing more houses onto the market, given where prices are?
I think absolutely. Normally, agents and the market will move in sprints, 6-week sprints, school holidays, shut down, and away it goes again. I think once we see the release from lockdown down here, I think it's going to be a nice steady climb through to Christmas time, the end of the year, with no real breaks. the conversations that our agents are having, and that what we're seeing there is people are just waiting for that release to just hit the market. There's yeah, we're expecting some big things, judging on the conversations and the sentiments there in the marketplace. People just don't want to risk waiting again. Once this lockdown ends down here, they are ready to hit the market and move rather swiftly and quickly.
Great, thanks, Peter. Stuart, over to WA and yourself. Got quite a few questions coming through here. In that data, that CoreLogic data, Perth seemed to be behind some of the major cities in terms of house prices. Is there a clear disconnect here in terms of what's going on in Perth compared to the rest of the country?
I love sitting on these national meetings where we in Western Australia tend to go the opposite to the rest of the country. I think Tim Lawless will probably back me up on this one. I think about 2009, the median price of property in Perth was about on par with Sydney. Probably not too different. But looking at all the stats we're talking about today, we're looking at Perth price increasing of about 11%, and that looking sort of pretty average. But agents in Perth are high-fiving each other because we've not seen growth. We've been static since probably 2013, 2014. Interestingly, that 11% means that we're still about 10 or 12% below the 2014 values. So we've had price increases. Everyone in Western Australia is sort of expecting a groundswell of demand that we're seeing to actually increase. But I'll just put some context onto things as to how low things sunk in Western Australia. Port Hedland gets mentioned an awful lot. Port Hedland's had a price increase of around 58% in the last 12 months. But it's still 7% down on where it was 10 years ago. So we've been through an absolute roller coaster in Western Australia. So what's happened over the last 12 months has actually been exciting for us. These agents have got a spring in the step here. And just to put some figures around it, we've had now probably the wettest winter we've had for 25 years. Ordinarily, you'd say that would keep people at home. It hasn't done. Our listing stock is down across WA about 6.5% for the last quarter. But there's pockets where listings are becoming that scarce that things are just flying out the door. I've got a list of suburbs where listings are down year on year, somewhere between 35 and 45% drop in listing volume. That's coinciding with that uptake of about 60% increase in settlements. So stock's decreasing, settlements are increasing. The agency Western Australia, we've got a really unusual statistic of our list to sell ratio is actually 1.1. So it's 1 to 1. So we're actually listing just slightly less than we're actually selling. And people ask me all the time, how is that possible? We're absorbing stock. So listings that we've had that have sat around for a little while are now being sold at an incredible rate. According to the Real Estate Institute, our days on market across Western Australia is now 17 days. This time last year it was 44. So we're looking at all the dynamics pointing in the direction of growth. We've not seen strong pricing growth yet. We think we will. But we've got stats from, again, the Real Estate Institute. There's a list of about 6 suburbs where the days on market now from the property hitting the market to receiving a contract is actually less than 10. So like northern suburbs, Kingsley, Heathridge, Kinross, people in Western Australia will know these places. South the River, Willetton, between 6 and 8 days on market. That's unheard of here over the last sort of 7 or 8 years. It'd be really interesting for us to just see the gradual growth in stats. But another really interesting fact is there's a list of 10 suburbs in Western Australia that have increased their sales volume over the last 12 months of over 100%. 7 of those suburbs are pricing is well below the median price in Perth. So what we're seeing is first home buyers that are now at about 32 to 33% Western Australia. That's increased dramatically over the last 2 or 3 years. First home buyers are now making up about 45% of all owner-occupied purchases in Western Australia. So those priced suburbs that are sitting below the median price in Western Australia are now actually starting to pick up. The sellers of those properties are then released to buy up the ladder, which is where we see the pricing will then start to pick up, across all pricing. We're actually looking forward to the next 2 years, to be honest. We think it's really exciting.
Sounds great. Now, we'll finish up. We haven't spoken about international buyers, and I might throw this back to you, Jeff. We still, there's obviously some very large prices being paid across the country. What do you see from the international buyers given COVID and how that's impacting things?
Yeah, and so the biggest component of the international buyers obviously has been the several 100,000 expats coming back. We've seen that impact both on rental and also on the mid to higher level markets. So that's been very, very strong. In terms of foreign nationals, probably taken a little bit of a breather, obviously still interested. And we believe that that's actually a really significant factor that's going to underpin the strength of this Australian market nationwide post-COVID. This will be seen as a very, very attractive place. We'll start to see immigration open again. And we think there's a lot of talk about bubbles, etc., but we think that the attractiveness of Australia for foreign nationals will be underpinning the strength of the market for some time to come, particularly in the mid to upper end.
And Tim Lawless, back to you. There's a question here in regards to the federal election, should occur in the next 12 months. Historically, kind of what impact has that had on property prices? There's basically back in 2017, property prices pulled back based on some proposed policy impacting the property sector. Can you give us some data perhaps on how an election affects the property market?
Yeah, to be honest, federal elections don't have a material impact apart from Canberra. Canberra absolutely sees a bit of a pause until there's a bit more certainty coming in. The most recent federal election was a little bit different because there was a lot more debate around negative gearing and capital gains tax reform. But even then, we didn't really see too much difference post-election. What really drove the rebound after May 2019 was an easing of lending criteria from APRA. They changed their serviceability buffer to be a floating rate. That really increased the availability of credit. And then we saw interest rates come down. Probably, obviously a certainty injection once we saw the stable federal government help things along. Going forward to the next federal election, it looks like Labor has completely discarded their negative gearing reforms and so forth as well. So my guess is there probably won't be a lot of disruption to housing markets. What tends to affect housing markets a lot more is things like monetary policy, so interest rates, credit availability, and then just the broader economy being labour market conditions, to a lesser extent, the level of internal migration as well.
And just finally, what trends are we seeing overseas? It's almost like the rest of the world discovered Australia 20 years ago, and property prices have been running ever since to catch up with global city pricing. What trends do you see overseas that may influence the Australian market?
Well, if you look at the Australian market, and we all look at the market and say, wow, how strong our conditions are here, housing market conditions are pretty much strong in every Western nation. In fact, Australia is probably around the middle to the lower end of the performance spectrum. You've got markets like New Zealand, which have recently introduced some macroprudential policies to cool the level of investment demand and housing prices. They're up more than 25% the last 12 months. US, Canada, UK have all seen housing prices absolutely surging. The commonality seems to be very low interest rates, a lot of fiscal support, and this reversion back to housing being a bit of a safe harbor. Other sort of macroeconomic trends we should be watchful for, of course, would be inflation. For example, in the US, they are expecting inflation to rise much more quickly than they originally anticipated. We could see some similar trends here in Australia, where the inflation target, which is 2 to 3%, could actually be met a little bit earlier than what the RBA has been forecasting. They don't expect their inflation target to be met until 2024 at the earliest. But if we do see a rapid rebound in the economy and a real tightening in labour markets, once things hopefully again go back to normal after these lockdowns, then we could see inflation or wages growth pushing inflation a bit higher and an earlier lift in rates. But that's completely uncertain at the moment.
Okay, great, everyone. Thank you for your time. Thank you for the agency and the agents, and of course, Tim from CoreLogic for that presentation. That's all we have time for, everyone. We'll see you again another time.
Okay.